Hi, this is Kerry Artac with Artac Advisory, and this is the AgriTalk video supplement for the AgriTalk PM show Monday, September 27th, in which I cover three markets: November soybeans, December lean hogs, and December cotton. Before I jump into the charts, just really want to encourage you to submit that free trial request. Give me your name, email address, and if you would, your phone number so I can reach out to you. You'll get 2 weeks of unfettered access to everything that I put out on a daily basis. And you'll also get a phone call from me early during the free trial period where we can talk about the markets you trade, the way you trade, if you have any questions. If you want to talk about, if you're a producer of any of the commodities, a rancher or a farmer, we can talk about your hedging needs going forward through the rest of the year and into next spring. There's that. But filling out that free trial form, you won't regret it. You'll get 2 weeks of unfettered access, and you never know. You may then become inspired to become a regular monthly subscriber. There are no long-term commitments. You can go month to month as most subscribers do. So let's jump into today's letter, or today's analysis. You are looking at a weekly continuation chart of the Chicago Board of Trade soybean futures contract. And it presently reflects the November 21 contract, which is the lead contract. This is just sort of a basic of longer-term thresholds. We have a ceiling at 14.20 3/4 that I'm not expecting, but I will be expecting under certain circumstances, which I'll give you in just a moment. But that long-term ceiling can contain buying into November expiration and really into through winter trade as it relates to the broader complex. In other words, the January and March contracts as well, when they inherit this chart, as they eventually will. 14.20 3/4 longer-term ceiling, below which this market remains heavy. Now, we are in the sort of two-sided framework as we have been for the last few months, but I do think 11.27 even is still sort of calling the market, if you will, still in reach, a bit of a magnet, drawing the market southward. 11.27, if tested over the next few months, as it may be, can absorb selling through next year. It is a long-term support level, the new floor of long-term support, as I call it, after we'd settled above that formation last November and then rallied up to the target at that time at 16.49 3/4. We could trade inside the 11.27 even to 16.49 3/4 region through next year, but I'm way ahead of myself here. So that's the big picture. The question is, are we going to test 14.20 3/4 first before testing 11.27 even? Or are we going to test 11.27 even first before we test 14.20 3/4? And I think the November chart has a lot to say about that. Right now, I have resistance, as you can see in this weekly November data only chart, at 13.03 1/4. It is a speed line that comes off that June high. And it can contain buying, at least on a weekly basis, quite possibly into later through October trade perhaps. And from here, the market remains heavy and likely to fall back to a decent support that's been holding the market. And I've had this on my daily letter now for weeks. It's held nicely at 12.32 1/4. So we could trade inside the 12.32 1/4, that channel bottom dropping weekly to 13.03 1/4 ceiling, that combination speed line and short-term channel top, well into October trade. But if we close above 13.03 1/4, then I do think that 14.20 3/4 long-term resistance level is likely to be tested within, I'm going to say, 1 to 2 months, 3 to 5 weeks possible. It could take into November to achieve 14.20 3/4, as I say, able to contain buying through winter trade. And just know that if we do get the buy signal above 13.03 1/4, that rally up to 14.20 3/4 is likely to be a hard-fought rally, as I would say, because I think the market remains prone to failure below 14.20 3/4. Not until we get above 14.20 3/4 at the end of any week, and I'll go back to this chart, do I see this market having placed a good annual low, then expecting bullish continuation back to 16.49 3/4. That could be as little as 3 to 5 months, or it could take into spring, summer of next year. Let's talk downside if we do close below this 1232 and a quarter formation, and bear in mind that is dropping every week. Then yes, within as little as 3 to 5 weeks, couple of months at the most, I would then expect that 1127 even long-term support level where we can bottom out through next year. Let's move on to lean hogs. Lean hogs, we rolled to the December contract recently from October, which explains that gap because the December contract was priced much lower than the October contract. And in the process, we tested what had been a target for a few months when we rolled below the 99.65 speed line last summer in June. We immediately then took on a low 70s objective. And if you've been listening to my lean hog analysis on AgriTalk, which I do talk about once in a while, you know that I've been expecting the low 70s. We hit that area last week, or we came very close to testing it within the 1% zone, so that it was an essential test. 71.27, able to contain selling through the rest of the year. From here, we could rally over the next 2 to 3 to 5 months back into the upper 90s. There's no clear indication of that. In fact, I think we should take a look at the December chart only, which you can see here. This is a weekly December data only chart. And in fact, last week, we closed above a trend defining speed line that this week is at 75.62. That is our support for the week, and above which I think bullish continuation over the next 3 to 5 weeks into the mid 80s is likely. And so you've got the 84.10 to 85.75 formations dropping ever so gradually that are now expected by the end of October. They can contain buying through the balance of December contract expiration. But if we were to close above 85.75 at the end of any week, and I think that's a long shot right now for the December contract, but let's say that, over the next 3 to 5 weeks, we happen to muster a settlement above 85.75, then yes, it is possible that under that higher volatility framework, that the market could rally all the way back to 99.65 by December expiration. I don't expect it, but if we close above 85.75, it becomes a real possibility. 99.65, once again, that long-term speed line on the weekly chart, able to contain buying into possibly through next spring. Now let's talk downside. If we happen to close back below the 75.62 speed line, 71.27 is then expected quickly, where once again, as I say, we can bottom out through the rest of the year. But closing the week below 71.27, we have ourselves a meaningful secondary sell signal that should play out into later year. The next several months, maybe as little as 1 to 2 months, but probably more like 2 to 3 months, then anticipating 55.67. 55.67 is a longer term channel bottom on that weekly chart that you can see here, and it can absorb selling through next year. So if we happen to test it by December expiration, or if the February contract tests it by expiration, because the February contract will inherit this chart, then yeah, we could bottom out there into next summer, possibly through next year, and from there trade higher over that time frame. I think that's all that needs to be said for lean hogs. Let's move on to cotton. Cotton needs to be mentioned here. I've talked about it maybe once every couple of months on the show. It needs to be mentioned again. I've been talking about this 91.35 long-term channel top we settled above several months ago, then eliciting a long-term buy signal that I think is ultimately going to at least yield that 111.95 rising channel top. And I think there's cause to consider the possibility of the lower 150s over the next year or two, given the longer term scope of that channel structure goes back 5, 6, 7 years. Yes, we could within a year or two reach into the low 150s. Way ahead of myself though. The bottom line here that I want to emphasize is this market remains bullish above 91.35, and why I want to be so emphatic about that is last week market actually broke significantly below that channel bottom, but did not close below it at the end of the week, and that is what's critical for me. You can it was a kind of a major flushing out, I think, of long positions. And so now this market can resume its upward course without having so many longs hanging on, if you will. And I think that's really what happened. It just shook them out. We closed back above 91.35, and this market can continue on up and should continue on up to 102.93 by the end of October, where we can top out possibly into December expiration. But if we close above 102.93, and this is a December weekly chart, FYI, this formation is rising every week. If we settle above it at the end of any week, then the 111.95 formation you can see here becomes really more of a 3 to 5 week target, rather than kind of the 3 to 5 months I'm anticipating right now. That 111.95 formation likely to contain seasonal buying pressures when tested, and if settled above, would of course accelerate upside momentum. Let's take a look at the downside, that if we close the week back below 91.35, then yeah, failed long-term buy signal. The market should fall back over the next several months to this 78.32 channel bottom on the weekly chart, where we can bottom out. You know, let's say we close this week below 91.35 and we test 78.32 by the end of the year. That can absorb selling through winter trade and into next spring. And that is all I've got to say for this week's AgriTalk video supplement. Don't forget to fill out that free trial form. You won't regret it.
So do yourself a favor. Fill out the free trial form on this website. Take that 2-week test drive. You have nothing to lose and much to gain.